A few years ago, interest rates were close to 0%, but today in the United States, they're about 3.5% to 4%. And that one change is the reason why mortgages got more expensive, loans got harder. But what actually happened and why does this affect everything? Welcome to Toyosis Finance, where we break down money, business, and strategy in simpler terms. Now, here's what most people don't actually know. The interest rate in the United States is actually controlled by the Federal Reserve, which is basically the US central bank, and they meet about 8 times a year to actually decide whether to raise the rates, lower the rates, or keep the rates the same. So when they make that decision, it actually affects the global economy and your daily life. So today we're breaking down how interest rates actually work in the real world. And interest rate is actually the cost of borrowing money. So when you borrow money, you pay interest, and when you save money, you earn an interest. So let's say you borrow $1,000 and interest rate is 1%. You'll be paying back $1,010. But if the interest rate is actually about 5%, you'll be paying back $1,050. Same loan, very different costs. So now let's imagine that across business loans, credit cards, or even your rent or mortgages. That's how interest rates actually affect the entire economy. In 2020, during the COVID-19 pandemic, the Fed actually reduced the interest rates to about 0% to encourage spending and to support the economy because businesses were struggling, people weren't spending as much, and the economy basically slowed down. But with the rate cut, borrowing became very cheap and inflation actually surged. Prices started rising faster, so the Fed did the opposite of what they had done by increasing the interest rate to about 5% in 2023. And in the US, the rates are still relatively high today at about 3.5% to about 4%. And you might be wondering, what's the correlation between raising rates when inflation is high? So basically, when inflation is high and the Feds increase interest rates, it makes borrowing or loans more expensive, and also spendings will actually reduce and demand is generally weaker. So let's imagine, for example, that your mortgage actually increases from about 1,200 monthly to 1,600 per month. You would have to cut costs in other areas. To be able to bridge this gap, now multiply this across millions of people. The economy will be slower and prices will stop rising fast. But on the contrary, when the economy is weak, the Fed actually reduce the interest rates. Because this will make borrowing cheaper, spending will become easier, and investments will be generally more attractive. For example, lower rates actually equals cheaper loans. So people will buy homes, start businesses, and spend more in general, and this will help to support the economic growth. So here's the key idea: interest rates actually control spending behavior. Higher rates will slow things down, while lower rates will actually help support the economy. And this is why interest rates affect your rent, your mortgage, your business opportunities or job opportunities, and even global markets. So one decision by the Fed could actually affect everything. So next time when you hear that the Fed is meeting, you might want to pay attention because a few decisions a year could actually shape your entire financial life. Thank you for watching this video. If you found it useful, give it a thumbs up and also follow Atoyasis Finance. Goodbye.